Hello everyone, Dave Landry here from DaveLandry.com. This is Trading Simplified. So what are we talking about? Well, we've been talking about trading resolutions, and I do want to follow up on that. But as you know, I like to let the market and setups and how things are unfolding dictate what I talk about. And I think right now it's very important that I update you on some market timing signals, show you what I'm trading, talk about the mystery charts, etc. And we'll do that in just 1 second. So again, state of the market, downtrend. We're in a downtrend now. We have some sell signals that are triggering and some downtrend signals and a major sell signal, which could trigger soon. And I'll flesh all that out in just 1 second. We have a new mystery chart this week, and I want to follow up on the mystery chart from last week. And then as time allows, we'll get back on the trading resolutions. By the way, housekeeping, I do take requests. If there's something you want me to cover, please let me know, and I'll work it in best I can into this venue. And if I can't work it into this venue, which has a limited time slot, on Thursdays, I do a live show at 6 Central, 7 Eastern. Would love to have you join me there. You can ask your questions live or send them to me ahead of time, and I'll be happy to address them. If you want to know where to send them, DaveLandry.com/contact. If you want to attend the webinar, DaveLandry.com/webinar. Sometimes I forget to update the date on this webinar page, so just register once, and you should be registered for all. If you want the slides from this presentation, all my other presentations combined, all three of my books in PDF format, and enough other stuff, including limited access to my website and a free market timing course, go to DaveLandry.com/StockCharts. Get to know me first before spending any of your hard-earned cash. All right, let's talk about some mystery charts and the methodology in action. Here's our mystery chart for this week. It's a sell short, and it's a bow tie and hit of parameters, 115, a stop at 125, initial profit target 105, or 10 points risk. So let's see what that looks like. Well, you can see the stock made all-time highs, consolidated a little bit, and now, after attempting all-time highs, again, and failing, it's beginning to sell off a little bit. Remember, these little blips on the chart aren't just little blips. They're actual trading by actual people. And what happens when a market begins to sell off from high levels is it creates what's called overhead supply. And it's just human nature. People looking to get out at break even. And if that rally doesn't push through this overhead supply, a lot of times the market will roll back over. But the setup is an actual bow tie here, which means the moving averages come together and spread out. 10 simple, 20 exponential, and 30 exponential, or the moving averages. And then you look to enter after a pullback. So let's take a look at the parameters here. A little bit of a pullback. Entries here. Initial profit target is down here. And just in case we're wrong, after it triggers, of course, we have a protective stop up here. Now, this was not a mystery chart. This was one that was recommended in my trading service about a week or so ago. And I showed it in last week's Trading Simplified. And it had sort of failed miserably initially, as you'll see right here. You can see where we're losing immediately in the trade, which is kind of par for the course on the short side. If you ever shorted stocks, seems like they always go against you. In fact, they should make that an adage. All shorts go against you. Write that down. Anyway, it did trigger, and the reason I mentioned it is not a mystery chart, as I thought a retrigger would be right around here if you wanted to take that trade. Sold off nicely, and it did hit the IPT. Before we get into that, just notice that it hit all-time highs and sold off fairly hard. So at all-time highs, again, getting back to the psychology, anyone who's ever owned the stock previous to those all-time highs is happy. However, as it begins to drop, they may be looking to get out at break even. So that's the overhead supply we're just talking about. So again, this is where we sold short. We took profits here, and on the remainder, we should stop out for a scratch. In fact, we lowered the stop to break even, and actually we did hit the stop this morning. The reason I say we should stop out is some of my clients, myself included, are applying a little bit of discretion and trying to hold a little bit past that stop, right around the 20 area or so, right around today's high. And if that gets taken out, then we have to exit, no questions asked. And overall, it'll be the better than a poke in the eye trade. Make about 1% overall on a trade, which isn't bad for 1 week's worth of work. You can see there's a 1%, and here's a remainder here, which mechanically, again, did stop out, and I'm applying a little discretion to see if I can hang on. Now, I did a presentation, as I said last week, I think it was last summer, right around the time the market was right at or near all-time highs, called before the bomb blows up. And the reason I said that is friends and relatives, long story endless, tend to call me when the market's down 30, 40% in a bit of a panic, asking me what to do, and usually by that time, the bomb's already blown up. It's too late. So what I thought I would do is get ahead of it and talk about market timing while everybody's happy and the market is headed higher. Of course, my phone's still going to ring in spite of that, but I have been showing everyone I know that presentation. Anyway, this is the TFM 10% system. We've talked about it quite a bit. A sell signal means you drop below the buy line, and you're also below the 50-week simple moving average. The buy line for this system is set to 90%, you can see it up here, of the 50-week close. So remember, again, this is a weekly chart. What's kind of interesting is this weekly signal triggered, as you'll see in 1 second, right before the pandemic hit in earnest. And what's kind of cool about that, I know you want to party with me, I'm such a nerd, is it triggered actually before shorter term signals actually triggered. So if we zoom in on this, you'll see that any close below 428956, so let's just say 4289 round numbers, on a closing basis, if it does close there, it could dip below it like it did the week before. That's okay. On a close below it, you want to go ahead and exit the market. And we show the results on this many times before, but as I said many times before too, market timing is less about beating the market and more about not letting the market beat you. And if you take a look at the pandemic slide and then it bought back in here, the buy is 2 lows above the 50-week moving average and also a close above the buy line. Now you'll notice that we got out here and got back in here a few percent higher. So technically that's what's called a whipsaw. And believe me, whipsaws happen. As Greg Morris says, though, whipsaws are frustrating, bear markets are devastating. You can survive frustration. And the thing I have beat the dead horse on as far as this pandemic slide from that close of right here down to the lows, that was round numbers, about a 30% drop. You can see how much the market has dropped from its highs, about 35, 40% from its all-time highs. And then from the sell signal, it was another 30%. So watching your equity drop from here all the way down to 30% lower, that's a pretty hard thing to watch. In fact, this is about the time my phone began to ring from a lot of people who were in a panic. And all they had to do was pay attention to what I do. Not that I want to be smug about it, because I feel bad that people lost money. The good news is a lot of these people held through it. Well, the only problem with that is that'll work until it don't, as I often joke. Because the market can lose 50, 60, and sometimes even more of its value. And losing that much money right before retirement can be a little destabilizing. Anyway, you can see we're still above the 50-week moving average, still above the buy line. In fact, if you kind of back up a little bit, market looks pretty darn good longer term in here in spite of all the gyrations and scariness we've seen lately. However, on a daily chart, a little bit different picture. Speaking of which, here's the bow tie proper order. If the 10 is greater than the 20 and the 20 is greater than 30, 10 simple, 20 exponential, 30 exponential, then as a general statement, the market is okay and you probably want to be long. We have that illustrated down below in the green. And I use the word illustration as opposed to indicators. I don't think indicators indicate anything. They just tell you what has happened in the chart, and it's possible that that trend, if one has developed, will continue. Now notice it did turn red back here, and around that time the market did get a little questionable, and it probably would have been a good time to consider exiting the market, maybe fire off a short or two, and at the least honor your stops. And then, of course, it went back to green, or mostly green. We did have a little yellow. Yellow means that the moving averages are beginning to cross back and forth. Could be a choppy market. Could also be the beginning of a rollover like we just saw in the overall market. But you can see, for the most part, it worked its way higher during that mostly green period. And again, we turned red once again recently, and we've been in a slide ever since. What's concerning is this is coming off of all-time highs. And again, at all-time highs, everybody is happy when the market begins to slide. then they get a little nervous. And last in is usually first out, or the last people in are usually first people out. The Johnny-come-latelys are buying somewhere in here, and they just throw in a towel and buy at these high levels, and then they're the first out. And then the other people who have bought somewhere along the line, as the market drops more and more, will feel more and more pressure to sell. Remember, as I preach, borrowing a line from Tom McClellan's late mother, Mary McClellan, people buy and sell stocks for a variety of reasons. Some people buy when they have money, and some people sell when they need money. And others, of course, use more sophisticated methods. If you look at the S&P 500 on a weekly chart, gives you kind of a good feel for where our market is in a longer-term cycle, much longer-term cycle. But you can see coming into 2000, obviously, we had a fantastic bull market. Notice that we turned red in 2000 and 2001, and we stayed there for quite a long time. And what happened? The market sold off really hard. Remember, this is a weekly chart. It stayed mostly green for a long, long time as the market came back. And believe me, sometimes they won't come back this quickly. It can take 25 years or more to come back. And a lot of people don't believe me on that. But if you take a look at the Layman's Guide to Trading Stocks, you'll see a lot more of this type of research, and you'll see that the market can lose quite a bit. Or go in and look at last week's presentation and my weekly charts presentations where I talk about the TFM 10% systems, and you'll see that the market can lose 90% of its value. In fact, just go back to the NASDAQ, which lost, I believe, 77% of its value in 2000. Now, take a look at the green here, again, from 2004 on, early 2003 or mid-2003. And you can see we had a decent bull trend. And then what happened again, we had another bear market. And this one was pretty ugly, dropping significantly. And again, all those diaper change moments are in the spreadsheet. If you can't sleep at night, you can download these presentations, davelandry.com/StockCharts, and check out the results of the system. And again, the idea, or I should say of the TFM system, but the idea in market timing is not as much beating the market, but more so not letting the market beat you. And so if you're using bow tie proper order, this is one little tool that'll help keep you on the right side of the market. Now, the only thing I'd warn you about with this is if you're looking at a weekly, you can go back to after the pandemic slide. We were green for a long, long time, and we did really well. In fact, we're still green, and we hadn't flipped over to the downside just yet. So we've been in a longer-term bull trend, obviously. Now, if you look here where it turned red, that was pretty much after the pandemic slide. The market had already begun to rally, and the bear market was over. So in this case, the signal was late. Now, this signal, the proper order of the weekly moving averages, can work really, really well if the market has a gradual rollover, like quite a few of the bear markets on a historical basis. But the reason I want to show you that it took a while to catch up is because you don't want to wait for some signal like this, which has a lot of lag to it, to catch up to the market. You want to pay attention to other things such, again, as a TFM 10% system, which gave you a sell signal on this week right here. Now, let's shift gears and get back to 22 trading resolutions for 2022. Number 13, I will do a serious pre-mortem on every trade. Now, what do I mean by that? I've been talking quite a bit about post-mortems on trades, and then in more recent times, I've been talking more and more about pre-mortems on trades. So a post-mortem, as you'll see in 1 second, is obviously after the trade, but you could save yourself a lot of grief by doing a serious pre-mortem, and as part of that pre-mortem, make sure you're doing a bit of an emotions check. And as I often like to say, is present Dave going to make future Dave angry? So ask yourself, is the trade worth it? And as we get further to resolutions, I'll give you a few things that will help you there. So how am I going to feel if this trade ends miserably? So if you take a mediocre trade and it ends miserably, then you will likely feel pretty bad. But if you're taking a fantastic trade and it ends badly, you need to be able to shrug that off. And we'll get to that in 1 second. I would do an honest post-mortem on every trade. And by the way, again, if you want to know more about the pre-mortems, I've been talking about that in the last several weeks in Dave Landry's The Week in Charts. My YouTube channel is youtube.com/C as in Charlie /Dave Landry if you want to check those out. So obviously we did a pre-mortem going into the trade, and after all is said and done, without the benefit of too much hindsight, pretend that you don't have all this hindsight that you obviously will have, you need to do that honest post-mortem. And you have to be really brutally honest when you're doing that post-mortem. Not to be confused with the post-Malone, by the way. By the way, is it just me, or does his face look like the underside of a school desk? I don't know who said that joke originally. It's not mine, but it's probably a meme I saw. But one thing you'd have to ask yourself, and again, you have to be brutally honest and try not to use too much hindsight. And I know it's nearly impossible not to. But did you really pick the best and leave the rest? And you're going to be amazed after you go through a few hundred or even 1,000 of these, right? And you go back and look at the chart, and perfect hindsight, of course, but you look at that chart and say, you know what, this is the same exact chart that I was seeing a week ago, a day ago, a month ago, wherever you put the trade on. And it really didn't look that good. But if it looks fantastic, then you're like, okay, well, it happens. Spelled with silent SH, obviously. Now, this is the hardest thing you might have to do as a trader. It's the hardest thing for me, is you have to work hard to separate luck from skill. And if you figure that out, write me a letter. Good traders, when they are doing their post-mortem, and even though they made money, sometimes a lot of money in a trade, and they look back and go, I don't know if I should have taken that trade. That's when the true enlightenment begins to happen. You're thinking, what the hell was I thinking, even though you made money? And it's hard not to have that bias built in based on the result. And Annie Duke calls that resulting. If you come up with good results from a trade, you're thinking, okay, I'm a genius. Well, maybe you just got lucky, and maybe you shouldn't have taken that trade to begin with. Now, on the flip side, as I was alluding to a few minutes ago, in hindsight, if you're thinking, you know what, I just got lucky on that one. It really didn't look that fantastic, and I want to thank the market gods for giving me a little bit of cash on that trade. So again, you're on your way when that happens. And then if you're thinking, well, I lost, but if I saw that same setup tomorrow, I would take it in a heartbeat. So very important to work hard to separate luck from skill. And that's not an easy task, but through repetition, you'll get there. And I would recommend you read Annie Duke's book, Thinking in Bets, for a lot more on that. Number 15, I will reward myself for following the proper process regardless of the outcome. And again, that resulting can be really, really, really tough. And the other thing, and this is something that I beat the dead horse on so many times, is that the market can be a really bad teacher. I was on an institutional project once, and I recommended something, and it worked, and my answer to the hedge fund manager was, well, it worked. And he said, well, you sure picked up nickels in front of that bulldozer. So really struck a chord with me that just because something works doesn't mean you should have done it. So reward yourself for following the process, not based on the outcome. Number 16, I will hold myself accountable. You can't blame the market. You can't blame your coworkers. You can't blame anyone else. And that's one of the toughest things about trading is there's nobody to blame but you. You're responsible for taking the trade. You're responsible for managing the trade and not micromanage yourself out of the trade. And again, by doing a really, really good pre-mortem, you're going to pick the best and leave the rest anyway. So your chances of winning on that trade are much, much, much better. Or being profitable, I should say. Number 17, I will embrace my emotions. As I have preached over and over and over again, it is impossible to separate emotions from decisions. And this research is based on the work of Denise Shaw, and before that, and probably where she got a lot of her research was probably from a gentleman by the name of Descartes. So one good way to explain this is those who have had injury or illness, who have been very unfortunate to damage that emotional part of their brain, they have a really hard time making decisions. And one example that was given is a doctor will ask a patient if he wants to meet on Tuesday or Wednesday of next week, and they'll go through a list of reasons why they should meet on Tuesday or not meet on Tuesday, or meet on Wednesday and not meet on Wednesday. But they'll never make a decision because one doesn't have the emotions, the stress, or consequence over the other in their brain. So when they say eliminate your emotions from trading, you would be not able to trade at all, and you wouldn't function very well in life, and you might have to be institutionalized. Number 18, I will keep a journal of my trading emotions and my feelings. And one thing that I had for a while, and I need to probably revisit this, do as I say, not as I do, right? Is a confession journal. And any time that I do something that I shouldn't do, I write it down. One thing in more recent times that I have been very cognizant of, and I've been talking about this in recent shows, is another one of those, which I got from Ray Dalio from his book Principles. So Einstein once said that the definition of insanity is doing the same thing over and over again and expecting a different outcome. Now, the perverse nature of markets is that if you do have a viable system, you might lose several times in a row and then eventually hit a really big winner, or hit it out of the park is what I'm trying to say. And that is similar to Churchill's saying of success is going from one failure to another without any loss of enthusiasm. So there's a lot of paradoxes when it comes to trading, and you really have to work hard to identify that bad behavior. Now, this isn't exactly easy, but I'll give you a few little hints. Again, like another one of those, if you keep doing the same thing over and over again and losing money, make sure you're documenting it, okay? One thing that I'm guilty of is getting a little too excited, especially if I'm doing an intraday trade, and I will maybe get in a little bit early on the signal as opposed to wait for some confirmation and use a stop entry. In other words, I might just jump in at the market instead of using a stop entry. And lately, by forcing myself to do a stop entry, a lot of times the market will rally up and then roll right back over, and I won't get triggered in. And I'd be willing to bet if I went in and if I would have entered all those positions at the market instead of waiting for that stop entry, I would have lost money over the past several weeks. And every time I miss one of those and resist that temptation to jump in, I write "whew" in my trading journal. Also, F-bombs. Every time I drop an F-bomb, I write that down. On days where I'm doing what I should do, I'll go all day without cussing and fussing. On days where I am, like as I said earlier, getting in on those setups early as opposed to waiting for the trigger and doing a lot of other bad behavior, I cuss and fuss, and I just can't seem to listen to the market and do what the market is telling me. Now, one thing I mentioned here recently, and you can tell it can be a very deep subject, but one behavior identified is what I call the walk in the office trade. If I leave the office, let's say to go eat lunch or go eat breakfast, and I come back to my screens, all of a sudden everything looks great, and before you know it, I'm firing off a trade. And I noticed that these trades don't seem to work so well, and then I later realized maybe it's because when I first walk in the office, something has changed with me, and it kind of hit me a few weeks back. Maybe I was hungry when I walked out the office, went to lunch, and come back and feeling better. An example I gave in last week's Dave Landry's The Week in Charts, again, which you can find on YouTube or my website, The one I'm referring to is on DaveLandry.com's homepage right now. And I talked about the fact that judges who give sentences after lunch were far more lenient than those judges who gave sentences before lunch. And their reasoning is they were a little possibly hangry before lunch, and then after lunch they're feeling pretty good. I'm like, let's not lock this guy up for life. Let's just give him 20 years or whatever the case may be. So you really have to be cognizant of what's going on. And I'm just kind of scratching the surface on this one. Well, that's all my time for this week. I want to thank everybody for watching. Again, if you have any questions, DaveLandry.com/contact, or if there's something you want me to cover. If you want enough information to keep you busy for a long time, DaveLandry.com/StockCharts. So again, I want to thank everybody for watching, and may the trend be with you.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.